Welcome back. You're here because you want the important info straight up, no messing around. Today, we're diving into something pretty crucial in finance, how auditors actually report on summary financial statements. Think of it as a fast track to understanding a key bit of the financial world.
Yeah, exactly. And our source today is the International Standard on Auditing 810, the revised version. Now, ISA 810 sounds maybe a bit dry, but it's basically the rulebook auditors use when they're asked to check out those shorter, condensed versions of a company's main financial reports.
Right. So our goal here is pretty simple. We're going to unpack ISA 810, pull out the key ideas, the main procedures auditors follow. By the end, you should have a much better handle on what a report on these summary statements actually signifies and, how much weight you can give it. Okay, first things first. What exactly are summary financial statements according to the standard? What are we actually discussing?
Well, to get summary statements, you first need to know where they come from. The standard talks about audited financial statements. These are the big, detailed ones, yeah. The full reports that have been through a proper audit following international standards.
The main event, so to speak.
Right. Then you've got the applied criteria. Think of those as the specific rules or guidelines management uses to boil down all that detailed information into the summary version.
Okay, like the recipe they follow to shorten it.
Exactly. And finally, the summary financial statements themselves. That's our focus. They pull key info from the audited statements, but naturally with less detail. The critical thing is they should still offer a fair snapshot of the company's finances, its position, its performance.
Gotcha. So it's kind of like the highlights reel of the full financial movie. You get the main story beats without every single scene. Makes sense. So when an auditor is asked to look at this highlights reel, what's their job? What are they trying to achieve?
ISA 10 is pretty clear on this in its scope section. It says the standard kicks in when an auditor is hired to report on summary financials that come from full financials they themselves have already audited.
Ah, okay. So it has to be the same auditor. That's important.
Very important. And their main goals were really three. First, decide if the way management used those criteria to make the summary was okay, was appropriate. Second, form their own professional opinion, are these summary statements fairly presented? And third, communicate that opinion clearly in writing in a report.
Right, so they're not starting cold.
Mm-hmm.
They're using all that knowledge from the full audit. That seems efficient. Now, can any auditor just sign off on any summary financial statements someone puts in front of them? Or are there hurdles they need to clear first before even taking the job?
Oh, absolutely. There are definite preconditions. It's part of what the standard calls engagement acceptance. The big one, like we just said, is that the full audited financial statements must be available, and the auditor doing the summary report must be the one who did that full audit. They need that deep dive understanding.
Okay, that link is non-negotiable.
Non-negotiable. And another really key point is understanding those applied criteria the rules management used. The auditor has to be satisfied that those rules are acceptable. Think about it. If someone summarized a book by just picking random words, you'd question the method, wouldn't you?
Yeah, you'd want to know how they decided what to include.
Precisely. Paragraph A3 in the standard actually gives examples of what makes criteria acceptable. Things like who's the company? Who's going to read this summary? Are there any laws dictating how it should look?
Okay, so it's not just about the numbers matching up. It's about the method for getting the summary numbers, and the auditor has to buy into that method. So once they've agreed, they've accepted the engagement. What kind of work do they actually do on these summary statements? It can't be another full audit, right?
No, you're right. It's different. The standard calls it the nature of procedures. The auditor does the specific checks they think are needed to form their opinion. Usually this means checking that the summary clearly says it is a summary and that it points back to the original full audited statements.
Traceability.
Exactly. They also compare the summary numbers to the full report numbers, make sure they align. And crucially, they evaluate whether those applied criteria we talked about were used correctly, consistently.
And how much digging do they do? Is it always the same level of effort?
No, paragraph 8 says the extent of work depends. It depends on how well the auditor already knows the entity from doing the full audit. If they have a really solid grasp, and maybe there weren't any major hiccups in the full audit, they might need fewer detailed checks on the summary.
Okay, so it's more targeted review, making sure the highlights reel is a fair reflection of the movie. And the editing, the applied criteria, was done right. So when does the auditor give it the green light? An unmodified opinion. What gets the thumbs up?
Well, paragraph 9, that's about the form of opinion, It says an auditor gives an unmodified opinion when they conclude the summary statements are prepared fairly in all material respects, according to those applied criteria. Essentially, they're saying, yep, this condensed version gives a true and fair view based on the agreed rules.
And what if they can't give that clean bill of health? When do they have to modify the opinion, put up a flag for the reader?
A modification happens if the auditor thinks there's a problem. Maybe the summary wasn't put together using the criteria properly, or maybe they just couldn't get enough evidence to be sure. And paragraph A9 makes a really critical point here. If the auditor had to modify their opinion on the full financial statements, say, they found a big issue there, then they absolutely have to modify the opinion on the summary statements too. It just wouldn't make sense otherwise,
Right.
giving the short version a clean pass when the original had issues.
No, that makes perfect sense. A problem in the source means a problem in the summary. You can't just ignore it. Now, what if there's a specific law or rule that says the auditor has to point out if the opinions are different?
Yeah, paragraph 10 covers that. If a law requires it, the auditor's report on the summary needs a separate paragraph. This paragraph specifically flags that the opinion on the full financials was modified and explains why. It's all about making sure readers of the summary get the complete picture.
Total transparency. Okay, let's talk timing. What if something important happens after the auditor signs off the main audit report, but before they issue the report on the summary? Do they just ignore it?
No, definitely not. Paragraphs 12 and 13 cover this timing of work and subsequent events. The auditor has to think about whether any of these later events impact the summary statements. If they find something that was actually true before they finished the main audit report and it could affect the summary, they need to talk to management.
And what happens then?
Well, they need to consider if the original financial statements need fixing. And if they need fixing, does the summary need changing too? If management doesn't do what's needed, the auditor has to reflect that somehow in their report on the summary. They can't just let it slide.
So they have to stay vigilant even after the main audit seems done and dusted.
Okay. What about when these summary statements aren't just out there alone? Say they're part of a bigger document, like an annual report. Does the auditor need to worry about the other stuff in there? Yes, they do. Paragraphs 14 and 15 talk about information in documents containing summary financial statements. The auditor's got to read that other information. They're looking for major clashes, inconsistencies between that other info and the summary statements, or even the original audited statements.
And if they find a clash?
They discuss it with management. If management won't fix the other information, the auditor might have to add a special paragraph to their summary report. It's usually called an other matter paragraph. Basically, it points out the inconsistency to the reader.
So they're kind of acting as a consistency check for the whole document, making sure it all hangs together. Okay, let's get down to the nitty-gritty now, the report itself. What are the absolute essential bits that have to be in the auditor's report on summary financial statements?
Right, paragraph 16 lays out the elements of the auditor's report. Think of it like a checklist. You need a clear title, something like Report on Summary Financial Statements. It needs an addressee who it's for. Then the core, the auditor's opinion. That's where they say if it's a fair summary based on the criteria. If the opinion is modified, there'll be a basis for opinion section explaining why. If the main audit had key audit matters, those really important issues they focus on the summary report might mention those too. It also has to spell out management's responsibility for the summary and the auditor's responsibility for the opinion.
Standard stuff for audit reports, generally.
Pretty standard, yeah. And then, of course, the auditor's signature, their location, auditor's address, and the date of the report. And paragraph 810 points out that the date usually can't be earlier than the date they signed off on the full financial statements. Makes sense, right?
Yeah, you can't report on the summary before you finish the main thing. It's summarizing. And you mentioned traceability before. It's vital. This summary report clearly points back to the original, doesn't it?
Absolutely crucial. Paragraph 16G is specific.
Yeah.
The report must refer to the audited financial statements and state the date of the auditor's report on those full statements. Gives essential context. Lets readers know where the info came from when the full audit was done.
And the opinion language itself.
Yeah, paragraph 16.8 says the opinion needs to state clearly whether the summary statements are a fair summary, in our material respects, of the audited financials, and if they followed the applied criteria. And if it's not a clean opinion, 16I requires that description of why, usually in that basis for qualified or adverse opinion section we mentioned.
Got it. Always trace it back. Now, are there situations where this report isn't for general consumption? Can access be restricted?
Yes, paragraph 22 covers restriction on distribution or use. If the rule's used to make the summary mean it's really only suitable for a specific purpose or a specific group, then the auditor's report should include a restriction. It says who it's meant for and that others shouldn't rely on it or distribute it.
Why is that?
Well, to stop people misinterpreting it if it wasn't designed for their needs. Maybe a bank needs a very specific summary for a loan decision. That might look very different from what a general investor needs.
Right. Context matters for who should see it. And what if the way the summary is put together is a bit unusual? Say, using different accounting rules than the full statements. Do they flag that?
Yes, paragraph 22 also mentions alerting readers to the basis of accounting. If the applied criteria mean the summary isn't based on the same accounting framework as the full audited statements, the auditor's report needs to point that out, warn the reader. Helps people understand what they're looking at and avoid making dodgy comparisons.
Good point. Let's think about comparisons over time. What if the summary includes figures from last year or the year before? How's that handled?
Comparatives. Yeah, paragraphs 23 and 24 deal with that. The standard basically says, yeah, summaries often include comparatives, that's fine. The auditor's main job there is to check if those comparative figures are also a fair summary of the previously audited financials they came from. The principle is the same. Fair presentation according to the rules.
Okay, so consistency applies to past figures too. Now, sometimes companies include extra bits of info alongside their financials, stuff that hasn't been audited. What if that happens with summary statements? Does the auditor look at that extra stuff?
Good question. Paragraph 25 addresses unaudited supplementary information presented with summary financial statements. The auditor needs to check if this extra, unaudited info is clearly marked as separate from the summary statements themselves.
So people don't get confused.
Exactly.
Right.
If it's not clearly separated, or if it's presented in a way that might make someone think it's been audited when it hasn't, the auditor should ask management to fix the presentation. If they refuse, the auditor might need to use that other matter paragraph again just to clarify things for the reader.
Right, drawing a clear line between audited summary and unaudited extras. Makes sense. Now, there's this term, auditor association. What does that actually mean when we talk about summary financial statements, and why is it important?
Auditor association, that's in paragraphs 26 and 27. It basically means the auditor has allowed their name to be connected with the summary financial statements, usually because their report is included in the same document. Now, if the auditor finds out or believes that those summary statements have significant errors or misstatements, they have to talk to management, ask them to fix it. And here's where it gets serious. If management refuses to make the necessary changes, paragraph 27 says the auditor should take steps to refuse to be associated.
Wow, okay. What does that involve?
It could mean pulling out of the engagement altogether, refusing to issue their report, or taking other actions to stop their report from being used with those incorrect summary statements. It's a pretty strong signal. The auditor basically saying, I won't lend my name to information I believe is materially wrong.
So they can actually walk away and say, nope, my name's not going on this if there's a big problem that isn't fixed. That's quite a safeguard, isn't it?
It really is. It protects the integrity of the auditor's opinion.
We've really covered a lot here, from defining summary statements, the auditor's role, the acceptance criteria, the actual procedures, forming the opinion, all the key report elements. It certainly sounds like ISA 810 provides a pretty solid framework aimed at giving users confidence in these condensed reports.
That's exactly the idea. ISA 810 gives auditors clear standards for these specific engagements and makes sure they approach them properly with professional skepticism. Ultimately, it provides you, the person reading the financials, with a reasonable level of assurance about these shorter reports. It's not the full audit opinion, but it's something meaningful.
So for everyone listening, hopefully this deep dive into IS 810 has, demystified things a bit, given you a clearer understanding of the assurance that sits behind summary financial information. It's definitely more than just shrinking the numbers down. There's a defined process, professional judgment, and that formal report signifies the auditor's conclusion.
Yeah, and maybe this leaves you with something to think about. Now that you understand more about the process for summary statements and the auditor's role, does that change how you view financial transparency? Or how you make decisions using financial info? What new questions does it raise for you about, say, the level of detail you really need? Or the trust you place in different kinds of financial reports you might come across? It's definitely worth thinking about those trade-offs. The quick overview versus the full detailed picture when you're trying to grasp a company's financial health